The theme of today's event is navigating stability with cautious optimism. And to bring us into the session of today, I'm going to be welcoming the Chief Investment Officer of Meristem Wealth Management Limited, Taiwo Yusuf, to take us on a very interesting welcome address. Thank you, Taiwo.
Thank you, Press, and good morning, everyone. Thank you, Press, and good morning, everyone. I welcome you to today's session, navigating the global economy, navigating stability with cautious optimism. As is customary with Meristem, we assist our clients to navigate their investment landscape, making investment decisions on our part, and for the benefit of our clients. To us, it's not a matter of chance, it's not a matter of luck. It's rooted in deep-seated analysis of what the economy holds in stock, both the domestic economy and the global economy as well. Today, as is customary for us, today is no different at all. We'll be doing justice to analyzing the global economy and also as well the domestic economy and the different asset classes. One thing I would say is this. We all know some months back or weeks back or maybe about a year back, what we were navigating was uncertainty. What we were navigating was volatility. It's interesting that this time around, what we'll be navigating is stability. And even in stability, you still need someone to hold your hand. You still need someone to tell you how do you navigate it. Because sometimes stability, after stability comes a storm. This time around, we're probably not expecting a storm. But whatever it is that the second half of the year holds in stock, we have a set of brilliant analysts that will be telling us what to do. Where should we be investing? What does global economy hold in stock? What does the domestic economy hold in stock for us? What are the asset classes? What should we be doing with those asset classes? We'll be getting an insightful analysis into all of this. They'll be telling us what to do. And just like all of you, I can't wait to know what H2 second half of the year holds in stock for us. And let's sit down, relax, and enjoy a deep analysis of what to do. Thank you very much, and let's have a very wonderful session. Please, I hand over to you.
Thank you very much, Taiwo. Thank you very much, Taiwo, for that introduction. And of course, Taiwo is both the Chief Investment Officer at Meristem Wealth Management and also the Director of Research at Meristem Securities. So we just heard from a legend. I'm going to be welcoming a set of presentations next. We're going to hear about the global macroeconomic environment. We'll hear about the domestic macroeconomic markets. And also we're going to talk about the fixed income markets, the equities markets, and our expectations for these different markets. For this set of presentations, we're going to have two different analysts come and give us insightful information. First up, we're going to have Felicia Awolokwe. She's the lead of the macros desk at Meristem Securities Limited. And after following Felicia, we're then going to have Victory George, who leads the equities desk at Meristem Securities Limited. Please join me as we have these two analysts. First up, let's welcome Felicia.
You're welcome. Okay, thank you very much, Grace. Good morning, everyone, once again. And I'll be taking us through what has happened in the global space, the global macro space, and what has happened in the domestic macro space also. I mean, coming into the year, we had expectations of, moderate global growth, as we expected that favorable fiscal policies from major economies and more accommodative monetary stances would favor business investment and drive growth for these economies. However, developments came up towards March, as the year progressed, as we saw the newly inaugurated president for the U.S. at that time, President Donald Trump, implement a broad-based, tariffs on major trading partners. And of course, this tariff implementations or these tariff announcements, as at that time had different outcomes for some of these economies. And they of course impacted trade volumes, it impacted economic growth, it even had its bearing on what inflation was for the first half of the year. For the US, this implementation of tariffs was one thing that gave manufacturers, investors, and it just brought up a lot of uncertainties as how these developments could impact the different aspects of the economy that I mentioned. We saw that the US economy in Q1 2024 contracted on the back of significant imports as manufacturers and households tried to front load their purchases from other countries into the US ahead of the implementation of these tariffs. And of course, this also had a bearing on inflation in the US. Like I mentioned, the global economy coming into the year, we expected that growth would be moderate for major economies, and we based our expectation on the potential favorable fiscal policies that we were going to see from major economies, and also the fact that a lot of monetary policy authorities have pivoted to a more accommodative stance, and we expected that all this would support growth prospects for the global economy as a whole. However, some developments came up as the US administration sometimes early in the year levied a series of tariffs on their trade partners, and on screen you'd see some of the tariffs, the countries that were levied on, and some of the details and status of these tariffs. Of course, since then there's been negotiations around these tariffs. Some of the tariff measures have been reduced, renegotiated, and there are still ongoing trade deals to sort of navigate this protectionist global trade dynamic. However, growth and inflation have actually felt the impact of some of the tariffs that have been levied. Like I mentioned before, the US economy contracted in Q1 2025, and one major driver for the contraction would be the surge in imports as businesses and households tried to front load purchases from other countries ahead of the implementation of tariffs in April. And of course, this meant higher import volumes, and this just weighed on growth potential and growth value for the US economy and led to the contraction that was recorded. But for inflation, for the first quarter of the year, there was not much impact as the implementation was going to happen in the second quarter. And coming into the second quarter, although businesses and individuals try to front load as much as they can, there would, the exhaustion of some of these purchases, happened, and we began to see the impact of these tariffs on manufacturers' costs, and of course, manufacturers started to pass this cost across to consumers, and this meant that the previous disinflation trend that the US economy had seen, reversed, and as of June 2025, US inflation had gone up to 2.7%, and, is getting further from the Federal Reserve's target of 2% for the US economy. And for the UK, their growth has actually been strong, and the major driver for growth has been the services sector, where output rather has increased, due to lower cost pressures and more activities from sectors like transport and the likes. However, the UK economy is not also insulated from happenings in the global space. We also saw that the implemented tariffs already started to impact price levels in the UK, whose inflation trend had been varied. Coming into the year, there were the first 3 months where we registered decline in the UK's inflation before moving to a mix of upticks and downtrends in inflation figures. As of June, the inflation also went up to 3.6% as the prices of grocery items and some transport services increased significantly. For the Chinese economy, we saw that while growth was, quite moderate and strong in Q1 2025 at 5.4% for China, as the front loading of purchases from US and other economy led to a surge in export figures for China, and this boosted growth figures for the first quarter of the year. We also saw that growth in Q2 for China moderated to 5.2%, and one thing that still continued to support growth would be that businesses are still trying, from other countries, are still trying to buy and import as much as they can from China ahead of the implementation of some broad-based tariffs that were announced later in the year. And what this means was that international demand remained strong for China, while domestic demand still continues to face the headwinds that were peculiar to the Chinese economy. However, China's inflation has, been on the moderate trend and on a moderating trend, and this is of course because, like I mentioned, the low demand, weakened demand, and domestic demand for the Chinese economy is something that continue to impact price levels. And of course, we've seen different favorable monetary policies from the Chinese economy and from the Chinese government rather, and even from the fiscal side to incentivize growth and to bolster output for the Chinese economy in the coming terms. For the Eurozone, growth was, positive for the first half of the year, for the first quarter of the year. And, what some major drivers for this positive growth would be the dovish economic stance that the ECB, the European Central Bank, has adopted, which continue to lower borrowing costs for businesses and just improved sentiment and businesses' capacity to plan and invest. And of course, inflation also for the Eurozone was moderate, as inflation even went below the bank's target of 2% to 1.9% in May, before ticking up to 2% in June. And so looking into the rest of the year, we expect that the growth prospect for the global space would still be moderate. There are still uncertainties around the extent to which these tariffs could impact the different macroeconomic indicators that I've spoken about. And this just brings, the potential of if this risk materializes, if higher tariffs continue to, strain manufacturers' costs and strain consumers' spending, it is something that would moderate growth prospects for the global economy. Additionally, in the first half of the year, we saw the escalation in geopolitical tensions, particularly between Israel and Iran, which had its effect on the commodities market as oil prices surged above $75 per barrel ranges. And this just is also another, potential risk for inflationary pressures that could materialize and could strain the supply side of things, and of course would have impact on global growth also. And so with this, cloudy outlook of potential risk materializing in form of tariffs, in form of geopolitical tensions, we expect that global growth will be moderate. And also, these risks are also something that could exacerbate existing cost pressures across some of these major economies, and have of course prompted the monetary authorities to adopt a cautious stance, as we saw that some of these monetary policy authorities have moved to a hold stance, trying to monitor and assess how these uncertainties would play out and what extent these developments and dynamics that I've mentioned would impact their separate economies in the long run. And so coming to the Nigerian economy, growth remained quite positive and quite stable for the first half of the year. And of course, this is against a backdrop of improving macroeconomic indicators, as the economy has observed a broad-based disinflation trend. Post-rebasing in January, inflation started to moderate, and currently as of June, inflation has moderated for the third consecutive time to 22.2%. Of course, for growth, one other driver would be, apart from easing cost pressures, would be the stability of the exchange rates, which is something that has moderated input costs for manufacturers and for import-dependent sectors and industries like, the manufacturers. For the agri sector, it has also moderated the input costs, as some of these inputs are actually, they are bought from outside suppliers, and this was some of these things are the drivers and contributors to the stable economic momentum that the economy recorded in H1 2025. Of course, recently rebased GDP figures that would also show that the economy still maintained its growth trend and trajectory, with growth printing at 3.13% as of Q1 2025. And going forward, we actually expect that growth will remain stable. Of course, like I mentioned, the stable macroeconomic conditions, moderating inflation that speaks to cost pressures, the stability in exchange rates, it is a major driver for sectors that are import dependent, is something that would bode well for the economy. Additionally, the hold stance from the monetary authority for the first half of this year also means that interest rate has been quite stable, which is something that would aid better business planning and investment strategy, and is supposed to also improve output, especially for sectors in this, for services and the industries. Also, for the economy, one major dynamic for the Nigerian economy has been the performance of the fiscal policy. How has the government revenue performed against what was budgeted, and how do we expect these things to continue to play out? For Nigeria, it has been a customary trend that budgeted revenue are always higher than actual performance, where we have maybe quite optimistic assumptions underlying budgets, which would just mean that when we don't meet these budget assumptions, of course, revenue would record a shortfall. And for H1 2025, the case was not different, as government revenue continued to underperform what was budgeted, especially given the recent revision or the revision of the country's national budget in the earlier part of the year. And so the fact that oil prices were broadly, low, at least relatively low compared to last year, printing mostly below the $75 per barrel benchmark, and oil production still remains below the budgeted 2.06 million barrel per day. This meant that oil revenue would, of course, underperform what was budgeted, and is something that would continue to, we weaken the government's spending power, especially for capital expenditures and for wealth creation within the economy. We actually expect that this trend will persist, given our expectation that oil production would not probably reach the allocated 2.06 million barrel per day by the end of the year, and this would of course weigh on what oil receipts would be and what total government revenue would be, and how much capacity the government would have to continue to fund capital expenditure within the economy. For debt levels, the continued widening fiscal deficit has of course continued to increase the country's debt burden, as the fact that revenue doesn't match up to what has been expected would mean that some of this shortfall will be funded by debts, and of course high debt servicing cost is also something that will still continue to strain capacity for capital expenditure, as the bulk of what is allocated would of course have to still go for recurrent expenditure in form of debt servicing. And for 2025, for the rest of the year, we expect that the country's debt burden will remain high, as even with revised with the revised budget size, it just opens up more room for the fiscal deficit is wider, and this just means that the country would have to take on more debt to be able to meet its obligations, which would deepen the country's debt profile and would continue to raise fiscal sustainability concerns about the Nigerian economy. For the external sector, things were quite positive, as improving macro condition, lowering inflation, strong economic momentum, and particularly the stability of the naira, especially with attractive fixed income rates, were things that continue to bolster capital inflows into the economy and continue to improve the CBN's capacity to support the exchange rates in the exchange rate market. All these are, factors that have improved the country's external sector position, and this coupled with the fact that the interest rates environment for Nigeria still remains attractive compared to what it is in other advanced economies. It just meant that investors, confidence in the Nigerian economy still remains somewhat sustained. And actually, we expect that going forward, this would continue. Investors' confidence in the country's economic space and macroeconomic landscape would continue to be strong. And this is hinged on our expectation of continued stability in the exchange rate market, as we expect sustained capital inflows. We expect a current account surplus to continue. We expect that oil receipts will also improve based off of our expectation of maybe more, improvements in production figures, at least milder improvements in production figures. All this would mean higher FX inflows and higher capacity to defend the exchange rate in the exchange rate market, and would of course mean that investors' confidence in the country's economy as a whole is going to be strengthened. And we even, our opinion is that if the macro space continues to strengthen, like we've seen. We might even see, improved participation in form of foreign direct investment in the economy in the mid to long term. And of course, Victory George would, be on now to take you through what has happened in the global and domestic markets for the first half of 2025 and our outlook for the next half. Thank you.
Thank you very much, Felicia, for running us through the macroeconomic environment. For the financial markets, the sentiment in the first half of the year was quite positive. And starting from the equities markets in H1 2025, a predominant bullish sentiment characterized the global equities market. And as we can see on the charts on the screen, global equities indices, returned quite good returns across, the U.S. markets, Eurozone, and also the SSA markets. And even looking at it vis-a-vis other alternative assets like gold, Bitcoin, and commodities, we can see that the equities market actually, outperformed some of these other asset classes. However, the first half of the year, was not without, its mixed sentiment and cautiousness from investors, particularly in the first quarter of the year, we observed, investors' cautiousness and, a risk of bias, and this was due to the geopolitical tensions, the Israel-Iran conflict, and also the trade war between the U.S. and other economies that weighed heavily on investor sentiment in the first quarter of the year. However, the second quarter, we saw that gradual rebound, in investor sentiment, and this was on the back of favorable trade negotiations. We saw some positives from the trade negotiations between U.S. and other economies, and the announcement of a temporary ceasefire between Israel and Iran. Additionally, the impressive corporate earnings performance in the first half of the year from different companies, was also a silver lining for the equities market, as investors, very much reacted to the better than expected earnings. And as such, we saw that rotation into defensive and tech related stocks in the first half of the year. As a result, the S&P 500 and Nasdaq returned 5.50% and 5.48% in the first half of the year. Looking at the domestic markets, like I mentioned earlier, the favorable macros backdrop bode well for the domestic market, as the NGX ASI returned 16.5% in the first half of the year. And this, rides on the previous years or sessions of strong performance for the Nigerian market. Even across sectors, the sentiment was very much positive, even though from the first quarter of the year, investors, were very cautious. There was that general lack of confidence in the market, but as we had expected, the earnings performance, for Q1 2025, revealed quite strong earnings, especially from companies and companies in sectors that were poised to outperform. Additionally, some sectors that did not do so well in the previous year, showed some signs of recovery from their Q1 numbers. I'm speaking to companies in the consumer goods sector, majorly real sector players, the telecoms players as well. Gleaning from their Q1 numbers, we were able to see the signs of recovery in their profitability and their overall earnings growth. And looking at the charts here, that majorly reflected in the strong gains that we saw across the different indices, especially the consumer goods index, like I mentioned before, returning 52% in the first half of the year, basically stronger than the returns we saw in other sectors. Also, based on the performance of the agri players in the first half, we saw that pricing, that upward repricing by investors, on agri sector stocks. And as such, the Meri Agric index returned 41.60%. And looking at the general dynamics of the equities markets, it basically just reflected stronger investors' confidence in the market, especially from foreign investors. We saw that higher influx of FPI transactions in the equities markets in the first half of the year, reaching about 1 trillion compared to 460 billion in the previous period. Also, domestic investor participation also increased. Particularly, we saw stronger, transaction from retail domestic investors, at certain times during the period. And this just basically reflects, the overall brewing confidence and, risk-on bias towards the equities market in the first half. Additionally, some major corporate actions shaped the market in the first half of the year. Firstly, we observed the listing of Legend Internet PLC, which also supported market activity, adding to the market capitalization and driving market activity. Additionally, we observed different activities from the banking players, especially around the recapitalization. And we saw different banks coming to the market to raise capital, particularly with the rights issue offerings and in the first half. And that was an activity driver for the equities market in H1 2025. And we still expect to see more capital raising activities from the banking players in the second half of the year. So generally, our outlook for H2 2025 for the equities market remains positive. We're optimistic, that the NGX will continue to record gains, and overall, we'll still see, strong double-digit returns for the Nigerian market for the third consecutive year. But our expectation is hinged on some factors which we expect to shape investor sentiments in the second half of the year. First of which is macroeconomic fundamentals, and which Felicia had rightly spoken about earlier. The easing inflationary environment, the stable FX environment as well, is one that is poised to sustain investor sentiment towards equity assets like we saw in the first half of the year. Additionally, the corporate earnings performance, like we had mentioned before, especially from risk sector players, we expect that to persist in the second half of the year. By the time the half-year earnings of different companies start to come into the market, and we expect investors to also reprice these equity assets higher, based on our expectation of sustained earnings growth for players in the market. Additionally, we observed, or we expect the activity of the monetary policy to also influence the equities market. An accommodative stance, or a sustained accommodative stance from the Monetary Policy Committee is one that is poised to keep investor sentiment, or continue to sway investor sentiment towards the equities market as investors look to capitalize or leverage on the impressive returns that the market has done in the first half of the year. Also, we anticipate that foreign investors' participation will still remain strong in the second half of the year, especially as foreign investors continue to cherry pick amongst fundamentally sound equity assets. Overall, our expectation for the equities market in the second half of the year is positive. However, it does not come without its risk. But from our analysis, the positive drivers outweigh whatever negative sentiments that we could see in the market. So we remain optimistic that the market would deliver very solid returns in the second half of the year for investors. Moving on to the fixed income market. The fixed income market was also bullish generally, but starting from the global space, we witnessed very sharp volatility in the global fixed income market, and this was due to the risk that persisted in the first half of the year, stemming from the geopolitical tensions and also the direction of the tariff wars. And as such, we saw that movement, from investors, trying to find where, the safest, place that they could place their funds or their assets. Especially like we've always known, the US market has always been a safe haven, for investors. But that was not really the case in the first half of the year. We did not see, that strong move into US markets from investors. Rather, we saw a sharp upticks in the bond yield. And looking at the charts here, we saw US 10-year bond yield, reaching unprecedented highs, touching the 5% levels in the first half of the year. Our outlook largely for the second half is that investors will still continue to react to movements, especially in the geopolitical tensions, and also continue to price in, their outlook generally for the US growth, and the growth generally for the advanced markets, the US and UK, and from the IMF revelation, the growth might still continue to be modest for the global economy. So we expect all those factors to continue to play in how investors price fixed income markets in the advanced economies. Moving on to the domestic fixed income markets, the market was quite bullish as the macroeconomic backdrop bode well for the domestic fixed income market in H1 2025. Largely, we saw a decline in treasury yields, both on the T-bills and on the FGN bonds, which declined by 517 basis points and 137 basis points to 20.2% and 18.4% respectively, compared to the previous period. And we attribute this largely to the robust liquidity in the system in the first half of the year. And to reflect this, or to evince this, the commercial banks were net depositors at the CBN discount window, and with a net deposit of around 93 billion, compared to the previous year where the banks were always net borrowers. Additionally, what contributed to the bullish sentiment in the fixed income market was the monetary policy decision. We saw the MPC keeping rates steady all through the first half of the year at 27.5%, on the back of declining inflationary pressure and a stable FX environment. So these factors put together spurred that bullish bias that we witnessed in the fixed income markets. And largely, our expectation for the fixed income market for the second half of the year is hinged on a couple of factors. First of all, we're looking at the movements in inflation and FX stability. Also, the monetary policy decision in the second half of the year. And lastly, the government borrowing, size of government borrowing. So we expect these factors to determine the direction of yields in the second half of the year. But our general expectation will continue to see yields at current level or slightly lower, with the average yields on T-bills and bonds declining to about 18.5% for the T-bills and around 18% for bonds. To digest these factors, or to do a breakdown of these factors, like Felicia had mentioned earlier during her presentation, inflation, we still expect inflation, to decelerate modestly, and we also anticipate, a sustained FX stability like we saw throughout the first half of the year. And we expect this to prompt the Monetary Policy Committee to be more accommodative in the second half, or by most expectations, tilt towards a dovish stance in the second half of the year. But on the fiscal borrowing side of it, we expect that a large chunk of government borrowing would also be from domestic markets. And this is based off our analysis of the borrowings that happened in the first half of the year, and where we saw the government raise around 11 trillion from the domestic debt market. However, on the other side of it, we saw net repayments being around 3 trillion. So this basically points to the fact that the deficit, still remains wide, and we expect that to play in the dynamics that we'll see in the second half of the year. We expect the government deficit, of the budget deficit rather, to be around 16 trillion, based on our analysis of government revenue, especially from the oil prices, and also we're expecting that we're expecting that some parts of government borrowing would also come from international sources, based on guidance from the Ministry of Finance, where they have revealed that $1.3 billion will be sourced from the DMO, and also 1.3 billion would also be sourced, from bilateral sources at concessionary rates. So we expect this to also filter into the activities of the fixed income market in the second half. And generally, we still expect liquidity to be robust in H2 2025. So these factors put together, form our outlook for, a slight decline in treasury yields. However, risks still persist, especially as investors, might continue to demand for higher rates based on their, based on the expectations for near-term inflation, considering near-term inflation risk, and also, movements in oil prices that might impact government revenue. Generally, for the financial markets, our outlook is positive, both for the fixed income and the equities markets. But we note that risks, while risks still persist, the market still portends very strong potential to provide strong earnings growth for investors. We will continue to monitor, movements and factors driving the markets in the second half of the year, and ensure that investors are very much guided on our positions and how to properly allocate our assets in the second half of the year. Thank you very much.
Thank you very much, Victory and Felicia. These two presentations we just had were very interesting and insightful, and I was taking a lot of notes. I mean, I was taking a lot of notes because there's so many things to learn and grow from there. And of course, we're going to be going into a question and answer session now. Our two brilliant panelists, presenters are back. They're going to be on the panel session with me, and I'll ask them questions about the macroeconomic environment and the fixed income market. Let's go to the panel session. Thank you so much, Victory and Felicia. I think I really enjoyed listening to both of you. I'm going to start with Felicia. During your presentation, you talked about the global economy and the things that we witnessed in H1. And one thing that was was almost headline almost every day was the fact that there was one new tariff by Donald Trump and the US economy to, in fact, even to countries where there were just pigeons and so on. So what do you say? How do you say the tariff implementation has affected the global economy? And of course, there's also conversation and questions about the US still maintaining its reserve status as the global currency. So Felicia, I want to hear your thoughts about this, all the happenings on H1 and how it has affected global trade.
Okay, thank you very much for the question. And like you mentioned, tariffs were a major headline for the global economy in H1 2025, and of course it has implications for different macroeconomic indicators of these economies that were affected. Like I mentioned, it could impact cost pressures as countries that have higher tariffs, their manufacturers would of course have to take on higher costs, and for essential items these costs would be passed to consumers, and of course it would impact monetary policy decisions and the likes, like I mentioned earlier. However, its impact on the US, supremacy as world currency is quite moderate. Yes, it looks like, there will be trade negotiations, there would be different talks and agreements, while the different economies affected are trying to protect themselves from, a likely occurrence of something like this in the future. But if you agree with me, the US has systems in place. They are major trade partners with a lot of these major economies. They have military presence in a lot of these countries, and all this would continue to necessitate the use of dollar as a major trade currency, particularly the trade aspect. And so while we could see countries begin to come up with, agreements and measures to protect themselves from, further occurrence or another occurrence like this, it's still going to take time to finally or totally take away the importance of the US economy as either a trade partner, military presence, and all that with these other economies. And so, although there might be slight shifts in the global trade dynamics in the near term, we still expect that in the mid-term, the US currency, the dollar, will still maintain its strength as world currency. Maybe in the long term, maybe say after a lot of these countries continue to take these measures up, we could now begin to see more, significant changes. But in the near to midterm, we expect that the US dollar will continue to be really relevant for trade.
Wow, thank you very much, Felicia. I'll quickly go to Victory. I'm still on the impact of this trade. I think, what do you think would be the impact of this on US fixed income assets? Because you also mentioned the fact that the US has always been known as a safe haven for investors. So, what do you think would be the impact of these policies? Like Felicia we already talked about the tariffs and all those things. What impacts is that likely to have on fixed income yields? Because I mean, there's been impacts for the first half of the year, but going forward, what do you expect?
Yeah, going forward, like we saw in the first half of the year, investors very much reacted to, movements in the trade negotiation, everything going on about the tariffs, and we saw the 10-year bond yield, touching 5% levels. So that status of the US as a safe haven, has not really boded so well, because from the activities in the first half of the year, we saw, investors trying to, play in other fixed income markets across Europe, but these markets are not really as deep or as robust as the US markets. So our expectation largely is that based on how this trade negotiations go, how this whole tariff thing goes in the second half, it would largely shape how investors price this risk in the US. And our broad expectation is that we might see a slight downtrend in the US 10-year bond yield to around say 4.5%, 4% levels by the end of the year. But at the end of the day, it's just how investors pricing this risk. And on another way I see it is investors' broad outlook on the future of the U.S. economy, looking at their the fiscal debt size, the growth, GDP for the U.S. and other advanced economies, is what investors will largely pricing for the second half.
That's interesting. I think we, of course, investors are also going to be talking about the impact of that on us, the domestic economy. And so with that, I'm going to come back to Felicia. How do you think businesses should position themselves for the changes that have been happening of course, the global economy, we've talked about that, but the translating impact of that to the domestic economy, especially with the exchange rates? We talked about how we are navigating stability now compared to when we're navigating volatility and uncertainty, like Taiwo mentioned. So how should businesses then position themselves in this second half, and even going beyond that with expectations for the exchange rates? How should businesses then begin to plan around this stability that we are beginning to see, of course, with cautious optimism in mind? I think you might also want to throw in investors, because we have investors trying to hold USD assets too. So how do you think domestic businesses and investors should position themselves?
Okay. For the domestic economy, like you've mentioned, we've been able to attain stability to a large extent. And so businesses can begin to make, capex decision, expansion decision, hinged off this expectation that stability would continue. Like you mentioned, for exchange rate, our expectation is to see, more stability compared to the sharp movements we've seen in the currency markets in the last 2 years. And so businesses that are exposed to, importation, that are exposed to fluctuations in the exchange rates, can begin to plan with, better information that, the currency is expected to remain more stable compared to previous years. And so you can make your expansion plans, capex decisions. And of course, we would also want to point out that our expectation for monetary policy is for, hold in the near term, with a possible transition into a more accommodative stance towards the end of this year. And so this means that even cost of borrowing would, soon moderate for businesses, and they can continue to make decisions based off this information. And so the picture we are painting right now is that yes, we have got into stability. If stability continues, it could begin to yield positive gains where expansion and more outputs, and even demand side, from the demand side, we've seen some fiscal reforms that the government implemented in form of tax cuts, tax exemptions, and all that would be implemented in 2026 and would boost the demand side of things. And so if demand will be healthy, and cost would moderate and stabilize, I think businesses, it just paints a bright picture for businesses in the midterm.
I think during your presentation, you also mentioned the inflation, the fact the inflation rate has more or less been moderating, and then even with base GDP still paints a picture of growth. PMI data all paints picture of growth. So I think just like you said, we can all agree that the expectations are more positive. Of course, there'll still be some risk, but more positive than where we were coming from. And I think I would also ask Victory this a very interesting question. So while we are all excited for expectations of expansion, investors that are focused on the fixed income markets might not be too happy right now compared to where we're coming from last year. At the beginning of the year, where we had the outlook, we said the fixed income market was the darling, but right now it seems like fixed income yields have switched. So how should then investors who are still focused on the fixed income market, still don't want to take the risk of coming to equities markets, how should they position themselves in the fixed income market for the second half?
Well, thank you very much. So for the fixed income investors, I mean, from the beginning of the year, we've had the expectation of yields, going to trend downwards eventually, but it was all going to be a factor of the macroeconomic environment, inflation, FX. So by now, a lot of investors would have or are already pricing in that downward movement in yields, and especially if we look at the dynamics of the Nigerian fixed income market, where short-term rates or the short end of the curve is very, very much more sensitive to changes in interest rates than the longer end of the curve. And when we look at what, like I mentioned during my presentation, the things that would drive the direction of yields in the second half, it points more to the bullish side. We're likely to see more of this current trend than the risk of yields trending upwards again. So for investors, where should they position, or how can they take advantage of this current dynamic? It would the juiciest part, or the juiciest way to position now would be to lock in funds more on longer dated instruments that are less sensitive to interest rate movements, and compared to the shorter end, where we'll be seeing that decline in yields. So for investors that have already done that, I mean, they would obviously be reaping the benefits by now. But based on our expectation for the second half, I think we'll see more investors trying to play more on the longer end, locking the higher yields. Then on the shorter end, maybe for liquidity reasons, we'll see, but more allocation to the longer end of the curve compared to the shorter end.
Before I let you go, speaking about the yields, for the longest time we've always said that the yield curve is inverted, where the yields on the short instruments, the interest rate you could get on short instruments were higher than, and that's kind of an anomaly in normal fixed income markets. So, but we've seen some improvements, some changes. So, are you expecting that change to be more permanent this year, or I mean beyond this year? And then, of course, like you already said, you advise investors to lock in on the long end. So if we are seeing that change in the yield curve, what does that then mean for investors? Should we wait to see the yield curve change back before we then lock in on the long end, or go ahead and do that now? So what would you advise investors to do?
I mean, it's best to when opportunities, or when investors can spot opportunities like this, it's best to take advantage of it before it eventually gets to that point where the yield curve normalizes. And from our previous expectation, maybe say a couple months ago, a couple weeks ago, we would put it that we'll see the yield curve eventually normalize, maybe early next year, yeah, or and beyond. But from the current activities in the markets, I mean, we saw the treasury bills auction yesterday, and where the stop rates, printed at, so it's just basically pointing in a direction that we might be seeing, short-term rates, falling faster than we even think. But again, pullbacks, yeah, are imminent. Like I mentioned, risks still persist, especially as investors, based on investors' outlook on near-term inflation risk, what government revenue is going to look like. So those things must still, put pressure on investors, to demand for higher rates, to compensate for these risks. But generally, if the macros remain stable, I'll continue to improve like we are largely expecting, yields will continue to decline, especially on the shorter end. So the long end is where investors should play more.
All right. Thank you very much, Victory and Felicia. It was very interesting, and I mean, our discussion has been a very enlightening one. Thank you for being here. We're going to continue with the presentation, and of course, we are going to move on to another part of it. This part is very interesting. I'm sure a lot of us have been expecting and waiting to hear about companies, about sectors. Which companies should we buy on the NGX? Where can investors begin to buy and carry out their investing activities? For now, we're going to moving on to talking about sectors. I have some wonderful analysts that are going to be talking about the different sectors, and of course, we can begin to take questions from the audience on the expectation for sectors and then for the market for 2025. I'm going to continue with the panel session, speaking to my wonderful panelists. I have Lovina Okoro, who is going to be talking to us about the telecoms and the energy sector. I have Matilda Adefalujo with me. She will be talking to us about the banking sector, and then there is Temiloluwa Oyenuga, who will be talking to us about the consumer goods and agriculture sector. I think I'm going to start with Lovina because you're right next to me. So, and one sector that has been very interesting this year has been the telecom sector. We came into the year and we saw the 50% hike in, tariffs for telecommunication companies. What impact do you think this had, on the companies? And then what should we then be expecting for the rest of the year?
Thank you very much, please. So, the telecom players, right, they've grappled with how to pass rising costs rising to the final consumers, right? And this 50% tariff implementation came as a breather for them, right? And for their Q1 performance already, we've seen gains, early gains. It was implemented in February, so we just had that first quarter performance, and we've seen early gains from there. And looking throughout, the outlook for them is that yes, we would continue to see improved revenue performance, right, for these players, MTN and Airtel. For Airtel, Airtel we still have like other markets in the African space, so it might not even be, we might not really see the impacts for Airtel as much as we'll be seeing for MTN, right? So yeah, the outlook is very positive, for the telco space.
Interesting. Wow, thank you, Lovina. So you're saying now I should just dump all my money in the telco space because you're saying the outlook is interesting. I should just so, and I think another thing for me for the telco space was also the fact that there's been some increase in the renegotiation of some of their contracts that they had in USD. Some of these things are things that affected them last year. So these contracts that contracts for their machines and for their heavy machinery that they use for production, and then of course to enable us to be able to make these calls. How do you think this renegotiation how do you think it's translating to their financials? And then beyond 2025, because of course we know we kind of have a feel of what we should expect for 2025. Beyond 2025 into 2026, how much more change do you expect to happen in the telecom sector?
All right. So, speaking to some of these these changes that we've noticed, from the headwinds that we had, especially for FX losses and the rest. So for a player like MTN, we see them trying to shift some of their debt position from FS denominated to Naira dominated loans now. And even in terms of operating expenses as well, we see MTN and Airtel come to share some of their infrastructures like the towers, cables, right? So all of that is still expected to help manage most of their costs. And like you said, moving, our outlook, right, is actually very positive for the telco space. We've seen MTN come out to announce the data center, right? They've set about $35 million, right? And out of that $35 million, we have $20 million marked for cloud services, right? These data centers is basically for storing digital information, right, and for quicker access, for digital information, and it's expected to help businesses, banks, right, and especially with the fact that these cloud services, they are usually priced in dollars. So MTN is coming now to say, you know what, we can offer these services for you also in Naira. And also we have in internet penetration, the world is evolving. We have technology here and there, the use of internet. So this is a win-win, right, for the telecommunication space.
I think one thing that has become very clear is that you really cannot wake up, in the day and not do something with telecommunications. So that sector and it seems like the possibilities are boundless. I think that would just take me to the banking sector. We know that there's been some, fracas between telcos and banking and banks in the few years, but the banking sector still remains a major a major pillar for the economic system in Nigeria. And so with all the gains of exchange rate gains, windfall tax, all those, a lot of story has happened in the banking sector over, a couple of years. And then this became into this year and it was forbearance. So what do you then expect for, of course, I would like to talk about the impact of the forbearance. I would like you to also, just give us a little bit of your expectations, what the banks are likely to do, and then with the CBN circular. And okay, so I think I will let you answer that first before I then ask the other part of my question.
Yeah, thank you very much. So if you remember last year, we were always talking about how banks have been getting a lot of circulars from the CBN, right? And then so many things have happened between 2020 and now. First, in 2020, that was when we even saw like forbearance really, it came up in 2020 where the CBN said, oh, okay, you have leeway to, be as nice as you can, with your interest rates, elongate tenors, and also, reduce or maybe not even make provisions for some loans because of the things that were happening, just trying to provide a sort of relief for businesses at the time. Now, the CBN is now coming up to say, okay, now, there's some level of normalcy, there's some level of stability in the economy. So now we have to take adequate provisioning for the forbearance loans that you've given out. And we also have to understand the fact that because of the fact that banks did not adequately recognize, these loans, it's made their capital adequacy ratio, their asset quality generally, appear more robust than it ought to be. So now what the CBN is saying is, let us do a cleanup of the house. Let us do a house cleanup and ensure that our balance sheets are actually as robust as they ought to be. So the impact that this is going to have, we saw the initial sell-offs on some banking tickers. Everyone, there was a lot of jitters in the market, and some banks came up to say, oh, we fully exited our, obligations. There were talks about single obligor limits and all of that. So, there's promise. There are promises from banks, and what we expect in H2 is that we'll see much more impairment charges because, it's expected that banks will now, make provisions for these loans, but asset quality is expected to, still be stable or robust as much as possible, because banks, yes, despite the fact that they have all of these situations going around, the banking sector is is the engine of the economy, and there is need to ensure that they make what's the word now, they are stable as they ought to be. So we'd see them, make, as like I said, provisioning, and also increase their revenue, different income streams, to ensure that they are as profitable as they ought to be.
So I like the fact that you touched on the payment charge, because while it's good to increase your revenue and keep making, and that's why I said this, that's why I side, because as much as it's good to keep having that increase in revenue on the one hand, it's also important for costs to be monitored. So are you, from your expectation now, you're still expecting that from the profit side of it, they're still going to be recording as much profit as we were recording in previous years? Okay.
Yeah, that's interesting, because like I said, higher provisioning, higher impairment charges would likely see cost of risk increase. Now, that's on one hand. Now, on the other hand, when we actually look closely, we'd see that we are back to core banking. We are back to, okay, what is the business of banks? So it's now away from high windfalls from FX, exchange rate, all of those gains. I mean, banks recorded as high as 3 digits, increases last year, even in 2023. So now what we are saying is, okay, what is the business of banks? Loans, giving out loans. So we'd see that loan advancement, transaction volumes, and also the non-interest income side would see more inflows from fees and commissions. And then now that banks, businesses are pivoting, or trying to build digital transactions, digital businesses, online banking, and even other fees and commissions based businesses, would see some more build and more income from that side of things. And we see some banks also playing more in the retail space. So we expect that the non-interest income will not suffer. It will not, we don't expect as much growth as we've seen previously, because there's more stability now in the FX. We're not, and you remember that the CBN also had said that, no more your net open position, all of those regulations. So we'll see tempered growth, but it's not going to be ignored, and there's no fear, I believe.
Interesting. So I'm going to go to the real economy, because they're the ones that were losing as the banks were enjoying the FX gains in 2023 and 2024. And now it seems like the story is, switching for the real economy, for consumer goods sector, agricultural players. Of course, telcos have their own bit to it too. So what do you think I'm speaking to Oyinda now, what do you think the main theme for the real economy has been for 2025? Of course, we've spoken about the macros, but for the companies' performance themselves, from their financials, what have you seen, and then what do you then expect to continue to see in 2025?
So, okay, I'm going to speak to the agricultural sector and then the consumer goods sector. So, for the agricultural sectors, the agricultural sector rather, performance in Q1 2025 was pretty good, impressive, just like what we expected. And really, this was really just on the back of improved revenue performance, and even though the cost pressure still remained, significant and strong, but then these companies continue to show resilience, and in spite of all that's happening in the macroeconomic environment, revenue was majorly, driven by improved volumes, and even benefiting from the elevated global CPO prices. This has translated even into the domestic market, and basically just helping their top line performance. And even for the consumer goods players as well, it's a different story from what we've always known, or let me say for the past maybe 2 years thereabouts, given the macroeconomic environment and how what we all know, how it impacted their performance generally. And from Q1 2025, the story has pretty much been different, especially with the the moderation that we're seeing in the FX, that was like the key driver to their losses and their bad performance in the past few years. And for 2025 now, we're starting to see some improvements in their numbers, and this was really just in line with what we expected. We saw some strategic initiatives by many of these companies to redeem or to get themselves out of these murky waters, and majorly just turning their balance sheets into a more positive position, the equity into a more positive position by converting some of these their FX denominated debt and all of that. And we saw how that translated to their performance for Q1 2025, and even for the rest of the year. I don't think the story is going to be different. We still expect that all of this would support performance for the real sector for the rest of the year. We're seeing the easing inflationary environment, which should help to ease cost a bit, and also the fact that these companies are also not relenting. They are taking initiatives to try to expand their revenue and at different areas of the market that they function in. So we expect this to bolster their performance, support their margins, and eventually improve productivity for the sector going forward, at least for the rest of 2025.
Okay, so I would also like you to comment on the potential impact of the MPC decision. The banking, Matilda, you also take a comment on that, and then what do you expect the MPC decision, the likely MPC decision that we're going to see? Of course, we've seen them hold rates through this year, and then there might be some room for rate cuts by the last quarter of the year, possibly even 2026. Those dynamics. How do you think this is going to be? What do you think is going to portend for the real economy? Just talking about all the companies, consumer goods, and of course we can only use a proxy for the companies listed on the NGX, but then the real economy itself. And then I think I also want the banking analysts to comment on that, because as the real economy might be having one impact, the banking sector, which of course derives a lot of revenue from the high monetary policy rates. I would like you to also comment on what's impact, or like you as well. So
for the real sector, it's going to be positive for them. It's a no-brainer. It's going to be positive for them. For the backdrop, looking at the backdrop, this has always been the challenge for them, coupled with other, macroeconomic factors that they had to face. The fact that they had a lot of high, interest burdens, given the, at the most recent meeting, we saw that the MPC held rates, and even for the rest of the year, we're expecting, a likely, cuts in, the policy rate. And what we, majorly expect from that, how that would, impact the sector, is the fact that we'd see lesser, cost burdens. Basically, it's going to, at least improve their cost lines. That is reducing their costs and giving them access to, cheaper credits, and majorly just improving their profitability. So for the real sector, it's positive for the real sector, and it's something that we are looking forward to start to see the impact on their books, and eventually the broad markets generally.
Yeah, so for the banking sector, just like Oyinda said, cheaper credits, where are you going to be getting the cheaper credits from banks? So look at it from two aspects. There is the interest income for banks, and then the interest expense. Now, on the interest income side of things, we're expecting that there will be some level of repricing. Of course, they have to reprice their loans in accordance to movements in the benchmark rate, and also since that is expected to maybe hover around the same levels or even become lower, what would see what would mainly drive interest income would be more of loans volumes, which is expected to go to the real sector. So it's going to be more of loans advancement. And also remember that banks are usually conservative when it comes to loans and advancement. So looking at expectations that the macroeconomy is relatively stable with inflation, reducing, and FX also stabilizing to a bit. So the fear that banks usually have in regards to their non-performing loans would abate a bit, right? And also now for the interest expense side of things, it's expected that since rates are around the same levels and even lower, inflation also moderating, the expense, their cost of funds, their interest expense was also go alongside with the movements in rates. So it's also on the balance of factors. Generally, banks would also still be able to to benefit from this environment, we are looking at yields, treasuries, banks would just be much more strategic, in terms of allocating their investment securities and also giving out much more loans to the real sector.
I think one thing that has been very clear from our conversation is that the main crux of the burden that the real sector, the consumer goods, agricultural companies were facing was FX challenges, and not really from inflation, because some companies could pass down the costs to their consumers. So I'm going to speak to the energy sector, because the energy sector is a major customer for the banks when it comes to these loans. So we're expecting, from what the banking analyst has told us, from what Matilda just said, we're expecting more loans to be doled out, in terms of volume, to maintain the banking interest income. We expect a significant portion of these loans to come to the energy sector, to the company. So what does that now mean for your expectation for the companies in the energy sector, especially with the fact that there has been some challenges with the global environments this year, with there's just from one shock to another shock to we call it endless crisis. So in putting all that together, what's now your expectation for the energy sector?
Well, for the energy sector, I would say is modest, right? The outlook is modest. I mean, let's even come from oil output. I mean, before the government would come to say, we have a target of 2.01 million barrel, target. We know it is unrealistic currently, right? But we believe that before they will come out to, it means they have policy in places or measures that they are trying to, put together, right, to ensure that they reach that targeted goal. And that is especially with the improved security, right? Though we've seen uneven gains with oil output, I think it came out very strong in January. We had about 1.7 million in January. Then, still uneven, but I think we had that improvement again, even with the latest reading. So I think all of that, especially for players there, we have Seplat and Aradel, it's still quite positive for them. And looking to the fact that most of these upstream players, they've expanded their production capacity. Looking at Seplat numbers, for example, in Q1, the production volume, it increased about 450%. So about 9.9 million barrel, right, for Q1 alone. So the outlook for them is still positive, right? But I think for the downstream, it's still modest, right? Because especially the gains would be very strong for off-takers from Dangote, right? Because they will still have to benefit from lower prices, right? And they have free logistics, right? All of that. So as the only thing again which would also want to be a positive for them is if global oil prices still does not plummet to those levels that we saw in April. So overall, we still have like a modest outlook for the energy sector.
So in terms of the pricing dynamics now, especially in the downstream sector, with the fact that there's been a lot of, I don't know whether the name is drama this year, a lot of back and forth between importers, and then of course we just come and today, and Dangote refinery has slashed prices again. It's been a very interesting. What do you think this is going to mean for these players, especially for companies that are, like you said, off-takers from Dangote, but for companies that are not going to be off-takers from Dangote, what would it mean for them? We know that MRS, one of the players, is an off-taker for now, and we saw the impact that had on their financials. So for those that are not off-taker for Dangote refinery, what do you expect for their financials in 2025? And then, of course, leading to the NGX, because at the end of the day, everybody wants to know what impacts would they have on, returns on the stock market.
So it's actually even reflecting currently, looking at Q1's performance. We know Entana and MRS, they had like that increase even in revenue. So for those those players that won't be getting from directly from Dangote, it definitely means lower market share for them, because definitely you wouldn't want to go to buy or get petrol for a place that is selling at a higher price. So consumers would definitely want to move to places that are cheaper. So that's why I said for the downstream sector, it's modest, right? So the gains would be tied particularly to those that like internal MRS that are getting from Dangote, because especially with that price war.
I think there's still been some positive movements from even those that are not, off takers, because still been some positive performance from like Total and the others. So I think it's still going to be an interesting environment to watch out for, especially in light of whatever is going to be happening in the global economy. The global economy is a major determinant for the energy sector. And before it's been an interesting conversation, but before I let you go, I think I would go back to Oyinda to just also hear your thoughts on, Presco and Okumu. So far on the NGX this year, Presco and Okumu have performed. I don't know how many percent that we can say year-to-date performance has been now, but I think is beyond when triple digits. Are we triple or double digits territory? What are the main drivers? Are investors trading on actual fundamentals, or are we trading sentiments? What are we? And then if we are trading on actual fundamentals, what do you expect if commodities prices now decline? Because those that are driven by commodities prices, if we are still now, because we're expecting inflation to decline and all those kind of things, especially in domestic economy, what impacts is that going to have on commodities prices and then filter into their own revenue and of course performance on NGX?
Okay, so for the listed players, Okomo and Presco, I feel that these two stocks are still very, and they are fundamentally strong tickers, and majorly what we've seen driving their performance. Also the fact that all that's happening in the macro, especially with I'll roll out that fact, but looking at their performance majorly, we've seen that this has really been driven by stronger top line, top line performance. Speaking on the volume aspect, right, we're seeing that a couple of or two of them, these companies, they are taking strategic acquisitions, and even the fact that many of their plantations, we're seeing them maturing. These are also also helping to improve their volumes. And on the price aspects, the fact that the global CPO prices still continue to trend higher, it's kind of favorable for them. Because the fact that also trickles down to the domestic front, that has helped improve their revenue. And also the fact that we're seeing a slower pace of increase in their costs. This has help to improve their margins and eventually their profitability. So basically what we're saying, on the exchange is not just, market sentiments. These stocks also still remain fundamentally strong. And I feel that that's why, investors are still trying to, buy in and, lock in the gains that they feel are still, very much existent in these two tickers. So for the agricultural players, it's not just sentiments. Their fundamentals are still also very strong, and we expect that to still be the case for them for H2 2025.
Thank you very much, Oyinda. I think we're taking questions from the audience, and one of the audience member, I think audience member asked why we have a negative outlook for telcos sector, and I think I want us to clarify that we actually mentioned that the opportunities are boundless, for the telco space, and there's going to be a lot of positives for that sector. Okay, before we round up this session, I would like you to give your final words on your expectations for each of the sectors, some of the major trends that you expect to drive, expect trends that you expect to be the theme for the last half of the year. You can even go beyond that into 2022, but the themes that you think we should be on the watch out for, especially because we just want to make money on the equities. So what themes do you think you should watch out for each sector? We'll start from Oyinda.
Okay, so for the real sector, agri players and even consumer goods players, for 2020, the rest of 2025, revenue is still going to come in stronger. and these companies, I mean, they're not slacking at all. They continue to still deliver strong revenue performance, and I feel that the strategic expansions and even relative price increases would also still support their top line. I mean, that's for consumer goods players. For the agri players, the continued the favorable pricing of CPU should also still bolster their performance, as well as planned volume expansions as well. And also, I won't rule out the fact that the government continues to intervene in the sector, and we still continue to see some concerted efforts by the government to try to improve productivity for that sector, and inclusion of some initiatives to help smallholder farmers, giving them access to cheaper and quality raw materials should help to eventually improve the sector's output. And then speaking on the cost front, I mean, the improving macroeconomic environment, the stable FX in the expected moderation in inflation as well should help these companies, because cost and their cost line has been a major problem for them, and if we're starting to see that improvement, definitely should trickle down to their bottom line, and that's what we really expect. And also, for consumer goods players, they've been in losses for quite a while, for the past 2 years thereabouts, and many of these companies obviously have not been declaring dividend because they've been in the negative for these periods. And now that we are seeing that the chapter starting to change for them, we expect that many of these companies will start declaring some favorable dividends, and we feel that investors also want to capitalize on that and buy into the ticker, buy into those those stocks. So for H2 2025 and even going forward into the rest of the year, I mean, I forgot to mention also that FX is also something that we expect to really bolster their performance. I mean, reduced FX losses, some of them, expect some of these companies to still now go, back into the profitable position. So, I mean, for the rest of 2025 and even, 2026, right, the story is positive for the real sector, for agri players and even for consumer goods players. So, I mean, investors can be on the lookout and definitely look at the attractive stocks and the ones that, are most profitable for them to, buy into.
I think I want you to add your topics from some of these sectors. Of course, I think for the agricultural players, we already discussed the Coma and Presco. For your consumer goods company, you can just give us maybe 3 topics for you that stand out in terms of what to expect from what these your expectations.
Okay, so 3 on my mind, at least for consumer goods, would be Nascon, Unilever as well, and I believe Cadbury, right? Those 3 tickers we're already seeing the momentum on those stocks, and I feel like there's even still more room for growth and positivity or expansions from these companies. So investors can lock in their needs. It's not too late to enter into some of these stocks, right? Because the upside potential on them, our views on them and what we expect for the overall sector is still quite positive. So we feel that investors can still enter some of these tickers and lock in their gains. So Nascon, Cadbury, and Unilever. Yeah.
So my Nestle, what should I do with my Nestle?
I mean, Nestle.
You don't have to answer that. Thank you. Let's move on to the banking sector.
Okay, so for the banking sector, trends would see continued recapitalization activities. On Tuesday, the central bank governor came and said that about 8 banks have completely, fulfilled their capital raising exercise, and everyone is asking which one is my bank there? Is my bank part of them? So we'll see, more banks continue to raise to try and ensure that they raise whatever capital shortfall they had before the deadline of 2026. Then another key thing would be bank going back to the basics, which is the business of giving out loans, some trading here and there, but would see, because I mean, just like I said earlier, the fact that rates are moderate now relative to what we had before, and the expectation of rates being as high as we had seen earlier is not really on the block, right? So there's going to be banks going back to the basics, and income would likely be tempered, but the sources of income would now, there's going to be a shift in the sources of income, where we add, high FX gains, trading gains, trading income, and all of that. We're going to see much more, transaction volumes, much more gains on loans and advances, much more gains even on, fees and commission income and all of that. Then for cost, I think cost is going to be relatively moderate because again, cost also answers to inflation. It also answers to the interest environment too. So we're going to see, tempered, cost is not going to be as high as we've seen, but I expect that the CBN would definitely keep being on the watch to ensure that the financial sector, which is the engine of the economy, and when we had talks about the $1 trillion economy, everyone knew that the banking sector would be the driver, and they are on the watch. The CBN is going to be on the watch to continue to ensure that quality is delivered.
I think before you give us maybe your top picks, I know we brought you here to talk about banking, but I want you to comment on insurance because they have similar, tandem to being regulators of the financial and the economy. Like, what do you think we should expect for insurance penetration in Nigeria? I know that all of us, when you goes to meet someone to say buy insurance, we hear, "Oh, I'm protected, I don't have to buy." So what do you think we should expect for insurance penetration in Nigeria, and especially with this sector? Just 1 minute short view on the insurance sector.
So for the insurance sector, just like you said, a lot of people believe in Jesus, blood of Jesus is my insurance, right? So I think that there's been much more should I say education and education about the insurance sector. We're seeing different moves, even like as a 9 to 5er, there is no way you'd work anywhere and you'd not have to have like a level of insurance sort of. So I believe that as we become much more financially literate, right? And there is more awareness going on about the benefits of insurance. It's not about the blood of Jesus. Yes, it's there, but I mean, there is need for you to be properly informed and insured. And something else that you didn't ask me that I want to just say would be that there are talks and whispers about maybe a recapitalization of the insurance sector. So that's something to also be on the watch for, to be on the lookout for.
All right, thank you, Matilda. And so we got to telecoms and energy. So you just give your final views on the trends, what you expect, trends that would definitely determine what telco space. And then, of course, we just have MTN and Airtel listed. So I think I want more of your stock picks from the energy sector.
Okay. So, I mean, just like we've discussed earlier, the demand for digital, we are already in that digital world. There's that evolving space currently. We have increased internet penetration, use of data for entertainment, for, there are many companies are coming up with different apps and the rest. So there's definitely going to be sustained demand for data, right? And just like I mentioned for MTN as well, with there are new interests now, the data center and all of that is something that we should also look out for. I believe investors are already pricing all of that in, with the recent rally that we've seen for MTN now, right? So yeah, the outlook for the telecommunication space is still positive. Also, we have the tariff, right, which is also expected to help sustain their margin. Previously they had that struggle with passing the cost to consumers. Now that they can freely do that, it should help sustain their margins. And FX, all of that, they are relatively stable now. So all of that should also help with their costs, especially with the fact that, Airtel and MTN now, they have come together to say, what, let's try to manage our CapEx as well, so all of that, is still positive. It's positive for the telecommunication space. So for the energy sector, yeah, I mean, the key thing we should actually be looking out for too is the global oil prices, right? So that would be a major determinant of how most of these companies will perform. So for top picks, yeah, we have Enter now, and there is Total.
Okay.
Right, yeah. Then if we are going for Austrian, we have Aradel and
Seplat,
Seplat. Yeah.
All right, thank you very much for joining me on this panel session. I think it's been a very interesting session, and I would say that we've learned a lot today. We've learned about the sectors, we've talked about the global macroeconomic environment. I want to sincerely thank my panelists for being here, my first panel session and my second panel. And we're coming to the end of this very, very interesting and I'm sure insightful session. I would welcome the head treasurer of Meristem Wealth Management Limited, Okemute Sagwa, to give us our final thoughts. And then but before she comes in, I would also say that you can keep reaching out to us on different platforms. You can send us messages, you can send mails, you have further questions that have not been answered during the course of this session. Please send us reach out to us. We'll definitely be here to answer your questions. And of course, we also you can take you have questions on investments and other questions that you have. Definitely we have advisors on hand to answer your questions. So I would welcome Okemute Sagwa now to take us on the closing remarks for this session. Thank you very much for joining us. Thank you, Okemute.
Thank you, Praise, and thank you, everyone. It's been a very, very interesting and engaging session today. Our outlook session for the second half of the year, navigating stability, right, with cautious optimism. I thoroughly enjoyed it. I learned so much. I hope you did too. We thank all our clients and our participants for joining us today. The team has done justice to the expectations, what we should expect and how we should position for the second half of the year. Thanks to all our panelists, Oyinda, Lovina, Matilda, yes, Matilda, and the guys that did justice to the macros as well, Felicia and Victory, sorry, and the sectoral reports, everything. It was actually very, very eye-opening, and we love to do this at Meristem because we believe that we have a lot of value to deliver to you, our clients, from all the sectors. We have no excuse that to be profitable, even for businesses, how to position, what to expect in terms of FX cost, managing your costs, inflation, everything looks positive, right? So position rightly, and we are here to also provide support to all our clients as you need it. Thank you so much, and to our moderator, Praise. Thank you very much, everyone, and enjoy the rest of your day. Bye.